Hello again and welcome back to episode 2 of Building Blocks. I'm joined today by Steven Marino, EVP of Portfolio Management at Great-West Life Realty Advisors, and my name is Craig England, VP of Portfolio Management at Realty Advisors with ongoing daily responsibility for investment strategy and operations of our 2 open-ended segregated funds. And I thought with that we'd jump right in, Steve, and I'd fire a question your way. There's this long-standing, I'll call it tongue-in-cheek misconception out there that real estate only goes up in value. We obviously know that that's not true and that the past couple of years have presented a series of challenges for real estate values. I was wondering if you might be able to just describe some of those challenges and talk about whether or not you think 2025 is a potential pivot point for performance.
Sure, great question, Craig, and certainly a topic that's getting a lot of airtime with investors today. It's important to acknowledge that indeed real estate is not immune to investment risk, and over the course of business cycles and investment cycles, we certainly see conditions that can be constructive, and in some cases, situations or conditions that can be a little bit destructive. It's really through a disciplined investment strategy that really focuses on creating long-term recurring performance that we can build portfolios that are well positioned to weather those storms and ultimately drive performance. And really that's what investors come to us looking for, that discipline and that ability to execute strategies over that long-term horizon. When I think about driving performance over that horizon, there's really 2 factors that time and time again drive performance. First and foremost, capital market conditions. Over the course of the last couple of years, we've seen a lot of volatility as it relates to the Bank of Canada and the corresponding implication on the 10-year Government of Canada rate. That's had some negative implications for capital values or capital returns over that period of time as discount rates have shifted upwards, and that's really been an impediment to value creation.
Can you maybe help people understand what a discount rate is and what the relationship discount rates with a risk-free rate or the 10-year Canada are?
So typically a discount rate is defined as the rate of return an investor would seek in order to rationalize investing to an asset class over a period of time. And typically a lot of investors would think about that as the premium above the risk-free rate. So if we think about today a 10-year Canada rate being in the order of 3 to 3.1%, historically investors have wanted something between a 300 to 400 basis point spread over and beyond that. And so thankfully over the last 6 months we've seen the underlying risk-free rates move in or come down, and that's created a nice positive momentum for discount rates to shift lower. And all things being equal, that will create value. And so that's one part of the equation that's now turned positive. The second is
it makes real estate relatively more attractive based on the size of that spread over the risk-free rate.
Absolutely. So the other element that's certainly constructive is cash flow and the ability to create reoccurring and growing cash flow. It can both mitigate the expansion of discount rates and the value impacts that would otherwise have, but as importantly, when conditions move favorably, like they're starting to, it can really be an accelerant to drive total performance over the near term as well. And so really excited about the fact that all 4 asset classes are seeing green shoots in terms of elements to drive cash flow and see a material increase in occupancy. Craig, maybe with that backdrop, we've talked in the past around how, theoretically over the last 20 plus years, all 4 asset classes have had their moment in the sun and have really driven performance. Can I ask you to think about moving into 2025, which of those asset classes in particular are you the most confident or convicted about?
I would borrow your answer from the last episode, in which I would say over the series of time, we continue to like all of the asset classes, but I know your question is specific about 2025 and maybe ahead.
Putting you on the hot seat.
So, I'll pull out my crystal ball and give it a shot. I think it depends on how far out you want to look. If we're talking about 2025 specifically, I think I would continue to bet on retail, which was the best performing asset class in 2024, and I would bet for that to continue. If we thought about a bit of a longer time frame and the set of conditions that our office market in particular has come through, I think there's certainly the opportunity for outperformance in that asset class looking ahead. But I will focus my comments for now on retail, and maybe I'll throw it back to you on the office question. Our retail strategy, as you know, is solely focused on grocery anchored centers. That means needs of life centers that people use as a source of convenience. By anchor, we typically talk about a grocery store, so your Loblaws or your Sobeys, that are complemented nicely by other uses that fit into that convenience bucket. So you can think about a pet food store or a pharmacy and things like that. Our grocery stores are typically on long-term leases, which provide stability of cash flow and predictable income. To your point, it's certainly a big part of our long-term performance objective. Whereas the other users within a center are typically on shorter term leases that offer the opportunity for us to reset rents more regularly and gives us the potential to create some alpha in terms of the overall return profile. And then lastly, there's two more things that are just kind of happening that I think are important that will drive performance in the near term. There's been some legislative changes that are going to likely increase competition from users across all of our centers. And investors typically are under-allocated to the sector, so increased demand for investment should be a positive for performance.
Craig, when you talked about the mix of the centers, you talked about the role of the anchor tenancy and then these other tenants that are occupying the CRU units. Can you talk about the cross-section or maybe the convenience that that retail format provides?
It's that foot traffic, right? So the foot traffic is being driven by the anchor. People are going to the grocery store. But it's the convenience of the ancillary uses or complementary uses around that make those other retailers want to be part of that center and locate next to a grocer.
Great context, thanks.
Yeah. So let's pivot to office. Certainly office has dominated the conversation, headline news, conversations within our office, conversations with stakeholders across the board, for good reason. The sector's experienced its fair share of challenges over the past couple of years. We all know what happened through COVID-19 and the pandemic. There's been a significant wave of new supply that has come on and is fortunately largely complete. But I do wonder if you could talk to the office sector specifically and the opportunities that you see ahead.
Sure. So when I think about office, I really think about its positioning as it relates to total performance, so both income and capital, over what I like to describe as the midterm. So maybe not necessarily near term, because I think there are still some challenges ahead of it, but I think this is a real constructive opportunity for office to have a pivot point, if I can borrow from one of your questions. Yeah. So when I think about that, there's really three key elements that are driving my thought process. One is valuations, the second is market fundamentals, and the third would be return to office mandates. So let's get at this. On the valuation side, office values based on the Canadian index data are off more than 30% on a cumulative 5-year basis. So effectively today, if you buy the book or the index data, you're buying a 30% discount to value relative to 5 years ago. That's an attractive entry point. As a value investor, we're always looking for assets that we think might be mispriced in the marketplace. If I look at our book of values, our office values are off more than 40%. We think that fairly reflects the assets and the underlying capital that they require. But in my estimation, that provides a real attractive entry point for those dollars remaining invested into that space moving forward. The second element is market fundamentals. Candidly, we've seen vacancy rates now plateau. 2024 marked the first year of positive leasing absorption since 2019. So again, the trends are quite positive. And maybe most importantly, we're also seeing a material pullback in new buildings being delivered to the marketplace. 2025 will mark the lowest supply of new inventory at 3 million square feet in over the last 20 years. So if you think about supply and demand, with a lack of new supply coming into the marketplace, every office building that exists today is going to be somewhat more competitive. Now, there are going to be winners and losers. Those that are best positioned are going to outperform. Those that are lacking are going to certainly continue to underperform. But
that's the flight to quality that we hear about.
Absolutely. But certainly the setup is quite nice for assets that have been well maintained, well invested in, and that certainly is a large element of how we think about positioning assets to perform over the long term. And then the final piece, the return to office mandate. If you think about private or public employers across North America, one trend is obvious. It is an increasing propensity to come back to the office and welcome employees back to the office. In fact, the most recent data says that the highest volume day of the week is 86% of pre-COVID attendance. And so there's no denying the trend is upward. More employers are asking employees to come back to the office with more regularity and really allowing them to redefine how they use the office as part of their broader cultural experience for their employees. So I think about the collection of those factors, it really positions office quite nicely as we move forward and really allowing it to take advantage of some of the material repricing we've seen in the marketplace.
I think that's helpful. Thank you.
Craig, maybe with the benefit of that context we've shared today, it might be opportune for you to share some thoughts around the London Life Real Estate Fund's Q4 performance and maybe its positioning for 2025.
For sure, happy to. I think I'll touch on three elements: occupancy, performance, and then a development project that we're excited about. Occupancy is critical to income performance, which you described earlier. Today, the London Life Real Estate Fund is 91% occupied. It's in a good place, but the overwhelming majority of that vacancy sits in our office portfolio, and we're working through that. I think a great example is that we just leased 100,000 plus square feet of space at Purdy's Wharf in Halifax, and that's just one anecdotal story, but we're seeing a lot more of that across our portfolio, kind of in line with your comments about where the market's been moving in terms of positive net absorption. And then second, performance. No doubt performance has been somewhat challenged, especially on the capital depreciation side across the portfolio. You were speaking about office, but broadly across the portfolio, we've witnessed about 11.5% drawdown over the past 10 quarters or so on property level capital depreciation. We think this is an exceptional opportunity as we move forward. And lastly, development. Tuner University is one of the best development sites in Toronto, and we were recently granted approval to convert part of what is today a 145,000 square foot office building into a brand new residential development, which will ultimately encapsulate 600 plus units of new multifamily. So those are the things that we're excited about.
Thanks for that content, Craig. That was great. And thank you to the audience for joining us today. As always, these sessions are really intended as supplemental information relative to other mediums of information you would receive from us. And we would really ask you to subscribe to our YouTube channel. And maybe finally, please feel free to share any thoughts or comments you may have. Our intention is really to use that as feedback to help shape content for our future episodes. Until we see you again.